It's a Tuesday evening in mid-April. You're 34, self-employed, sitting at your kitchen table with cold coffee and a laptop open to your tax software. You've just done something roughly 4 in 10 freelancers and small business owners quietly do every spring. Nothing dramatic. No offshore account, no fake company. You padded your expenses a little. You claim the corner of your bedroom as a home office, even though it's also where you fold laundry. You called a family trip to Orlando client development because you mentioned your business to a stranger at a hotel bar. All told, you shaved about $6,000 off your taxable income. It doesn't feel like fraud. It feels like what everyone in your networking group does without losing sleep. And the thought that makes it feel safe is simple. Nobody's actually checking this. That thought is the lie. It's the same quiet reassurance millions of people tell themselves every filing season, and for most of them, nothing ever comes of it. That's actually part of what makes it dangerous. The system is built to let the majority slide through untouched, so the few who get caught can serve as the example. Here's what actually happens the second you hit submit. Your return doesn't land on anyone's desk. It's ingested by IRS computers in Martinsburg, West Virginia, and run through something called the Discriminant Function System, DIF for short. It's a statistical model, not a person. It scores every return filed in the country based on how far your numbers drift from the norm for your income bracket, your profession, your region. The system knows what a plumber in Ohio typically spends on vehicle upkeep, and what a freelance copywriter in Texas spends on software. If your numbers stray too far from that pattern, your score climbs, not because a person suspected you, but because a machine noticed you don't look like your peers. DIF is only the first filter. The one that catches far more people is quieter and less discussed: the information returns processing system. Every client who paid you more than $600 filed a 1099. Every bank reported your interest. Every payment platform, PayPal, Stripe, Venmo, reported what moved through your account. The system adds all of that up and checks it against what you reported on your Schedule C. This is called document matching, and it runs automatically on every return, every year, without exception. If your clients told the IRS they paid you $12,000 and you reported $8,000, the $4,000 gap doesn't disappear. It sits in a database, tied to your name, and it can resurface at any point in the future. Your accountant, when you'd asked him if the home office deduction was really okay, waved it off. Everyone does it. Don't worry, he wasn't lying to hurt you. That reassurance is the product you were paying for. But it wasn't built on the law. It was built on convenience. Months pass. You forget about it. Then a thick envelope arrives. Department of the Treasury, Internal Revenue Service. Your stomach drops, but the letter inside isn't an accusation. It's a CP 2000 notice or an audit request, written in flat bureaucratic language, simply asking you to substantiate a few line items: receipts, invoices, proof. This is a correspondence audit, mail only. And it's where the overwhelming majority of taxpayers actually meet the IRS. At this stage, nobody thinks you're a criminal. You're just being given a chance to explain. And how you respond here quietly decides everything that follows. If you have real receipts, this ends in a week. If you don't, you have 3 paths. You can amend the return, pay the tax and interest, and move on, painful but survivable. You can ignore the letter, which doesn't make it disappear. It converts a small, fixable problem into a larger one, with penalties and interest compounding by the day. Or, and this is the trap, you can fabricate. Open an editor, create a receipt that never existed, backdate an invoice, write an elaborate explanation for an expense that isn't real. The moment you submit one falsified document, everything changes. Underpaying tax is a civil problem, you owe money. Submitting a false document to a federal agency is a different category of act entirely, a knowing, written lie to the U.S. government. That's the line between owing money and committing a felony. Say your explanation doesn't hold. Maybe the ink looked too fresh, or the pattern of aggressive deductions just didn't add up. Now a real person shows up, a revenue agent, in person, at the address you listed as your business, which happens to be that same laundry corner office. Agents are trained to spot the gap between what your return says and what your life actually looks like. It's sometimes called the economic reality check, and it's exactly as uncomfortable as it sounds. If your return says you netted $30,000 but you're driving a leased European sedan and your kids are in a school that costs $20,000 a year in tuition, the agent doesn't need your receipts to be skeptical. Your lifestyle is its own document. and right now it's contradicting you with a summons. The agent pulls your bank records, every account, and runs a deposit analysis. Every dollar that came in compared against what you reported. If $40,000 moved through your accounts with no matching income on your return, the law treats that money as unreported income unless you can prove otherwise. And the burden has quietly flipped. It's no longer the government's job to prove you earned it, it's yours to prove you didn't. Proving a negative, especially about money already spent, is brutally hard. The agent doesn't stop at your accounts. They call your biggest client to confirm what was paid. They call your landlord to confirm your rent. They call the dealership that leased your car. None of this needs a warrant, it's just phone calls, each one adding a data point to a picture you can't see yet. And they look at years, not one season, because one unusual year can be explained. A decade of spending that outpaces income cannot. Every interaction is being logged. The agent has real discretion here. They can write this up as an honest mistake or as something that looks like willful fraud, and how you behave in the room shapes which one they choose. Around this time, you call your accountant. His calls start going to voicemail. This is the stage almost nobody sees coming, and tax lawyers only discuss it quietly. The eggshell audit. It's a civil audit that has secretly become a criminal one, and you have no way of knowing, because the agent is not permitted to tell you. During a routine audit, agents watch for specific patterns known informally as badges of fraud: 2 sets of books, fabricated receipts, cash structured to dodge reporting thresholds, income understated the same way for years running, records destroyed, direct lies told to the agent's face. When enough of these show up, the agent doesn't confront you. They simply stop the civil case and quietly refer the file to criminal investigation. From where you're sitting, nothing looks different. The letters stop. You assume you've weathered it. You have not. You're standing on a floor that's already cracked. And every new document you produce to plug a gap in your story, every friendly, over-helpful explanation, is a new, freshly time-stamped offense, performed for investigators who are quietly building a file. Here's the part that makes this level so dangerous. The same instinct that got you here, the belief that you can talk your way out of anything if you're just charming or clever enough, is the instinct that destroys people at this stage. People who've talked their way out of parking tickets and bad contracts their whole lives walk into this room and do what's always worked. They over-explain, over-cooperate, volunteer documents to seem helpful. Every one of those documents becomes evidence. Every offhand comment becomes a potential false statement if it's even slightly wrong. The agent doesn't interrupt. They let you talk, because a target who explains everything is building the case for free. This is exactly why experienced defense lawyers, the moment they smell an eggshell audit, tell their client one thing that feels like guilt but is actually the only safe move: stop talking. Most people don't know the IRS has armed federal agents, not auditors. Law enforcement, criminal investigation, CID, employs roughly 2,000 special agents who carry firearms, execute search warrants, and make arrests. Within federal law enforcement, they're known for an unusually high trial conviction rate, consistently well above 90%. The reason is simple. By the time SID opens a case, they're already convinced you're guilty. They're not investigating whether you did it, they're building the version of the story a jury won't doubt. Subpoenas go out to your bank, your credit card companies, and, critically, your accountant. Facing his own exposure for signing off on returns he knew were inflated, he's already talked to agents. The conversation lasted hours. By the end, he wasn't your advocate. He was a cooperating witness. Agents don't need a confession. They have your deposits, your lifestyle, your fabricated documents with their mismatched fonts and timestamps, and a cooperating witness who will testify to intent. They reconstruct your real income using two long-standing, court-approved methods: the net worth method and the cash expenditures method, techniques the Supreme Court has upheld for decades. Here's how the net worth method works. Agents calculate everything you owned on one date, and everything you owned later. If your net worth grew by $400,000 over 5 years, and you spent another $200,000 living, that's $600,000 that passed through your hands. If you only reported $200,000 in income, the remaining $400,000 is presumed unreported, unless you can prove it was a gift, inheritance, loan, or already taxed money. Most people can't prove that, because they weren't keeping records to justify money they were trying to hide. By the time the reconstruction is finished, your finances have been mapped more thoroughly than you ever tracked them yourself. The case goes to a federal grand jury, which, under a prosecutor's direction, almost always returns an indictment. And the charges stack. Tax evasion is one felony. Filing a false return is a separate felony for every year you did it. 5 years of the pattern means 5 counts. Lying to a federal agent is its own charge, which is exactly why the eggshell stage mattered so much. And if real money moved through your accounts, prosecutors often add money laundering, the charge with sentencing guidelines far harsher than tax fraud alone. The number that matters now isn't the $6,000 from that first return. It's the total back taxes across every audited year, a fraud penalty of 75% on top of the underpayment, and interest that's been compounding since each original due date. That $6,000 shortcut, combined with its years of accumulated penalties and interest, is now a 6-figure number, and that number is what federal sentencing guidelines are built around. Long before a jury is seated, the government moves on your assets. Federal law allows seizure of anything connected to the alleged crime, and it happens the moment the indictment is returned, not after conviction. Your bank accounts freeze without warning, which means the money you needed to hire a strong defense lawyer is suddenly gone. That's not an accident. It's how the system is designed to work. A federal tax lien attaches to your house, blocking any sale or refinance. The leased car gets repossessed. The lien becomes public record, visible on background checks and credit reports. Vendors who extended you credit on a handshake pull it back. Your credit collapses. You don't lose one relationship. You become radioactive across the entire financial system, almost overnight. The same way a single flag data point once spread quietly through IRS databases at level 1. More than 9 in 10 federal defendants take a plea. Because the alternative, the trial against a mountain of forensic evidence, with a lawyer you can barely afford now that your accounts are frozen, usually means a much longer sentence if you lose. Under federal sentencing guidelines, a 6-figure tax loss combined with concealment and obstruction enhancements typically means real years in federal prison. There's no parole in the federal system. You serve at least 85% of whatever you're given. And here's the twist most people don't expect. The debt doesn't go away. It survives bankruptcy. You can't discharge it in Chapter 7 or Chapter 13. You serve your sentence. Come out with a felony that closes off most licensed professions and corporate jobs. And the IRS is still there, still owed the money, with interest that never stopped running while you were inside. Whatever you earn afterward can be garnished. Whatever you accumulate can be levied. Depending on the size of the debt, that can follow you for the rest of your life. Why it happens this way: you saved $6,000 because an accountant said everyone does it. The government spent years and real money getting that $6,000 back, along with every asset connected to it, and a decade of your freedom. Not because $6,000 matters to the federal budget, because deterrence does. The honest truth is this: the math, on any given year, favors the person who inflates their return. The IRS audits under 1% of returns. Most people who shade the numbers are never caught. But the system doesn't need to catch everyone. It only needs to catch enough people, and make what happens to them public and total enough. That fear does the enforcement work the agency doesn't have the staff to do itself. You're not just being punished for $6,000. You're the example, the story that gets repeated in networking groups and family dinners, that keeps the other 99% honest enough to think twice. That's why a rounding error on a Schedule C can end with a judge measuring your sentence in years. And your accountant, who served his own time, lost his license, and testified against you with a shaking voice. You can't even bring yourself to hate him. It started with 4 words he genuinely believed: everyone does it. He was half right. It was the second half, don't worry about it, that turned out to be the most expensive lie you ever believed. None of this means every deduction is a landmine, or that the IRS is lurking behind every home office claim. Most people who make an honest mistake fix it with a letter and a check, and that's the end of it. The real danger was never the $6,000. It was the moment fear turned into fabrication, the point where a shaky deduction became a forged document, and a forged document became a federal case that no accountant, no charm, and no amount of talking could undo.